Hello everybody, Rick Malero here with His Capital, and if you remember in the first video we talked about why commercial real estate was such an amazing vehicle to build wealth. On the second video we started covering a little bit more about how to implement the commercial real estate investments, at least a summarized version of what it goes into it. But in this video we're going to focus on specifically showing you case studies of how commercial real estate has worked for us and some of our partners, and also we're going to show you how you can get funding for them or how you can invest with as little as $5,000 and get in these types of commercial deals. So let's get going. Okay, so the first case study that I want to talk to you about is what we call a stabilized purchase. This was a 12-unit multifamily project that was actually acquired, and it was from Fayetteville, North Carolina. And what we did is, as a real estate investment company, we provided the bridge capital for the investor that was buying this deal. The purpose of this investor is that he wanted to take down this 12-unit apartment complex that somebody previously had stabilized, meaning that the property was already fully occupied, it's been fully renovated. This guy wanted no headaches. He was looking to build long-term passive cash flow with multiple units. So now the reality is when you're negotiating a deal, especially one that's stabilized, if you can buy quickly with cash, you get a better deal. We gave him a 12-month bridge, giving him the time to then go back to an institutional bank and refinance at a 20-25-year fully amortized mortgage in the rates of 4%. So in essence, he leveraged us to invest in this specific project so that he can build a cash flow while he works on his exit strategy, which is to refinance long-term, and then he'll let the tenants pay off the mortgage. So for him, the benefit is he gets cash flow and he lets his tenants pay off the mortgage so that within 20 years, he now owns a building free and clear. And so let me give you some basic numbers here. He basically is buying a project that is producing approximately $78,000 a year. And after all of the operating expenses, his net operating income is $45,408. So we're able to bridge him the money, but obviously we can't finance 100%. And I'll explain my psychology as an investor with why we lend a certain number. But again, his objective was to take this project that's producing a cap rate of 9. The appraisal showed that based on a capitalization rate in the market, basically, that the value of the property is about $370,000. But when you analyze the numbers based on a sales comparison approach, meaning what they're selling for in that neighborhood, they're actually selling for over $500,000. So our investor has built-in equity. He's now got cash flow. We bridge in the capital, and within 12 months, he's going to refinance that property, get a much lower interest rate, and he'll be able to sit back, relax, collect some of that net operating income, and let the cash flow roll in. Now, as an investor, when we lend money to him, one of the important things is that we can win too. We gave him the ability to have capital to close in as little as 10 days on this commercial property, and that speed enabled him to negotiate the price from $450,000 to $365,000 because of his ability to execute quickly. We lent money at about 70% of the purchase, so we're in this deal for about $255,000. So in the event that he defaults, we have an incredible investment for our company, but if he does perform, we get a solid annualized return while he pays us while he's finishing the refinance. In this next project, I'm going to talk about how one of our operating partners in our fund worked on a project that we call Washington in Arizona to buy a distressed 12,000 square foot office building so that we can literally stabilize it. Now, the important thing is, unlike the other project that I talked about that was already fully stabilized, producing cash flow, this building literally had a 0% occupancy, so it's producing nothing. The reason why this project was acquired was because it had so much potential once stabilized. So what our operating partner did is they basically bought this project for $1,025,000, but they negotiated terms. And what I mean by that is since the property wasn't producing income, they weren't getting as much activity. So this gave them the ability to negotiate not only the price, but also negotiate terms. And in the end, after 6 months of negotiations and going back and forth, they were able to secure this particular project with a 5% interest-only mortgage for 5 years, but they don't have to make payments for the first 9 months, and it's not even being accrued to their end balance. You see, the biggest issue they had in this office building is that they really had 12,000 square feet, but they were plated so that you would have to have maybe 2, maximum 3 tenants occupying the entire space. Well, in this market, that's a little tough. So what we're able to do with this particular strategy is repurpose the building, turn it into residential, retail, and office. And by breaking it up, you're able to really increase the value and increase the cash flow. Now that you got the story, we know the purchase price of $1,025,000. a capital improvement of about $200,000, maybe a little bit less. Now, the key is we're being able to convert this asset into multiple types of income streams. Now, the total projected multiple income stream is an annualized cash flow of about $144,000. So this is a great deal that will produce passive income, so the strategy is to hold long term. But the beautiful thing is that you still get an amazing value add. So these are the kind of deals that we're excited about because we're able to turn a negative into a positive by repurposing the asset, making it perform, and then ultimately turning it into a long-term play. So in closing, you've learned in previous videos about why commercial is great. You've learned about how and the basics of how to implement. And then we've talked about a couple of case studies to show you how profitable and how different strategies can help you to build that long-term wealth. So at the very end, I want to share with you one final strategy, and it's called action. You see, most people talk about doing business, and the few that actually do are the ones who generate wealth. So don't be that person in the sideline that's sitting down contemplating it. Take massive action and begin to build wealth. Now you may say, well, Rick, I don't have all the money to take down deals. So let me tell you this way. If you're thinking of about being an active investor, meaning you want to actively buy, you want to stabilize the project, and then ultimately hold it and refinance, then just call us. We're happy to help you with doing a bridge loan to finance your project in a short term so that you can buy it, renovate it, and then secure long-term financing. Now, some of you may say, well, Rick, I want to be more passive, but even if I wanted to be active, I don't have enough to even put a down payment or work a deal out. If that's you, that's still no excuse. That's one of the reasons why we created our third fund, which is called His Capital Fund 3. It is a Reg A offering, and investors can invest as little as $5,000, and they can participate in commercial deals, both in the lending side and in the equity investments like the one we talked about today. So we hope you'll consider those opportunities, and regardless, remember, without action, nothing happens. Wish you the best.